looking at our crowding analysis, crowding. So what we're looking at when we talk about crowding, what we're trying to flag are extremes in options market positioning that we want to tactically fade or take the other side of from a shorter term signaling perspective. So on the y-x axis, we're looking at the deviation in skew. So 1 year Z score, 2-month 25 delta skew. On the y-axis, we're looking at the sort of the volatility risk premium as measured by 30-day at the money put implied vol divided by the mean of 10-day, 20-day, 30-day realized vol. I had a great question, great discussion with a new Pro subscriber the other day, saying, hey, why do you look at that instead of just 30-day or 10-day or whatever? What we don't want to do is bias the sample for things that are rolling off the back of the sample. So what we're trying to do is create, a proxy for the entire sort of immediate term vol surface. It's not a perfect analysis, but again, if you look at, imperfect analyses consistently, you're going to start to see signals. And this thing has been a rock star year to date in terms of flagging some of these very important pivots in financial markets, i.e. like what we saw in last Saturday's around the horn. But one thing I'd flagging it again, look, options market positioning is still positioned relatively bullishly given the volatility and the risk that we're seeing. Minus 21% implied volatility discount for the SPY. Obviously, it's very depressed skew relative to the trailing 1 year mean. You're kind of seeing this on a median basis for all the 29 ETF U.S. equity ETFs in our sample. You got things like healthcare, quality, size, the IWM, that's small caps, real estate. The Qs in here, X's, there's a lot of U.S. equity ETFs featured in this correction probable crowd. Now, I'll say that to say this: we're heading in OPEX. There's a decent amount of put exposure struck around 4,000 in the S&P. So it's shorter term in nature. So you're going to have a decent amount of that gamma rolling off in this OPEX, and so you're going to get the unwind of those hedges. We already started to see it last Friday, obviously, on Friday. We're going to start to get more of the unwind of those hedges from a charm perspective. That's just the change in delta relative to price. Oh, sorry, relative to the time. Sorry, my apologies. So you're going to start to see that. But again, as we're flagging here, do not expect what we saw in March in terms of the post OPEX sustained, kind of recovery in risk assets. I don't believe the setup for that is just not the same. And another thing I'd flag with the analysis this week is that we're getting a BTFD signal in ag, one of our core long positions in the portfolio construction. So you're getting a short squeeze probable signal in there. So for those of you who have not yet allocated to the ag or certainly allocated in size yet, definitely getting a good opportunity to do so heading into this week. But one thing I want to flag, just going back to this sort of Vanna and charm flow risk in terms of perpetuating a continuation of this very short-term positive price momentum we're seeing in the stock market and correlated markets. VIX curve backwardation or the lack thereof suggests limited scope for an OPEX-driven melt-up. And what I mean by that is the kind of melt-up we saw coming into and through the March OPEX, which was obviously aided and abetted by the unwind of the event risk associated with the March FOMC. And as a function of that, or March FOMC catalyst, we saw a lot of fear heading into that. And what I mean by fear is we saw a lot of backwardation in the VIX curve. So this is 6-month VIX minus front month VIX, and got very, very freaked out. Markets got very fearful into that. And so that created a lot of, Vanna flow risk in terms of, going back to a contango, taking it out of backwardation, taking it back into contango. And that created a lot of upside in the market as dealers unwound the hedges associated with this rush for front month protection. We didn't get that same rush front month protection into this decline, which is conspicuous to say the least. Obviously, we touched, we had a 38 handle on S&P briefly for this week. So to me, I think that's pretty telling in the sense that investors, we have not seen that capitulatory style sort of, market signal that historically the Fed has responded to. Certainly they responded to that in COVID. They responded to that in 2018 as well. And then obviously responded to that in 2016. If you think about the Shanghai Accord, or Yellen took her foot off the brake pedal a little bit and allowed China to ease and reflate us out of that mess. So just want to flag that again. The setup for a sustained kind of post OPEX melt up is just not as robust as it was in March and April. So don't expect the same kind of response in markets